Now, as we come to the close of 2018, it's time to look back and recount the existing deals and also to take stock of all the transactions which really made an impact on the deal street. Now, on all parameters, 2018 has been a blockbuster year for the deal street. Deal values have crossed a whopping $100 billion. Now, some themes were predominant. For one, the success of deals under the Insolvency and Bankruptcy Code. So remember that the distressed asset space alone has clocked in deals worth about $10 billion. Other themes, consolidation in many sectors, as well as some of the large global deals where MNCs have been fighting it out. So these were the key themes. I have compiled a list of top 10 deals in no particular order of preference, and here they are. HUL got a Horlicks boost by merging GSK Healthcare with itself, and Unilever's push helped it clinch the deal against Nestle. Walmart acquired Flipkart for a whopping $16 billion and a massive one in the new age sector of e-commerce, and marks the convergence of e-tail and retail. Our good old economy sectors are not too far behind, because Kumar Mangalam Birla took the leap of faith and Hindalco announced the acquisition of global aluminium player Aleris for $2.5 billion, the largest by an Indian conglomerate overseas in recent times. Aditya Birla Group's Ultratech also fought a fierce battle against Dalmia Bharat to acquire Binani cement under the NCLT process, which has, remember, changed the rules of the IBC game. Another large conglomerate, Tata Group, was not too far behind in taking advantage of the buying out of assets under the IBC process, and Tata Steel bought Bhushan Steel. So metals deals have been topping the chart under the IBC process. But Tata Steel also announced the formation of a joint venture with ThyssenKrupp Group for its European operations. So it's quite a tie for Tatas and the Birlas on the deal street. Now, while a lot was expected from the financial services space, a few fructified, and biggest being IDFC Bank and Capital First merger to create IDFC First Bank. After the consolidation, remember, in the telecom sector with Idea and Vodafone merger, well, consolidation in cable TV came in next, with Reliance buying Den Networks and Hathway Cable. So consolidation in hospitals was also very big after a hotly contested battle for Fortis Healthcare, when clinched to buy global player IHH. Another deal at the fag end of the year is KKR-backed Radiant buying out Max Healthcare to create the third largest hospital chain in India. So a good comeback for Radiant, which was keen on Fortis. So those are the large transactions we are going to delve deeper into one by one. So 2018 saw some big brands being sold. Horlicks, Complan, all these are very well-known brands. But I'll focus on HUL acquiring GSK Consumer Healthcare, giving it a valuation of 31,700 crore rupees. And by way of merger, so one GSK Consumer share will yield 4.39 HUL shares. Now, a big push came in from the parent company of HUL, Unilever, and that really clinched the deal for HUL against another big contender, Nestle. In fact, Unilever is pumping in about $500 million as a global transaction to buy out Horlicks brand as part of this deal, and also 82% in GSK Bangladesh. And also remember that it also has a component of an OTC contract, and taking that extension for 5 years for GSK Group companies. So that's an important bit in this large transaction where HUL gets the Horlicks boost.
First and foremost, I think we are actually quite excited because it's a transformative proposed merger. We get an opportunity to actually play in the largest health food drinks market in the world, and is the fastest growing. So therefore, when you look at the possibilities and the opportunities of what you can do in the category and the brand, we are extremely excited. The second thing it also does for us is that it also gives us a scale in our foods business. When the proposed merger goes through, our foods and refreshments business will be over 10,000 crores, which will also put us at one of the top players in the foods and refreshment segment. So we are absolutely delighted with both aspects, and therefore I think it's really a transformative one from an HUL's point of view.
In Another big transaction really waiting to happen, simmering for a long time. Walmart completes deal to buy Flipkart for $16 billion. It acquired 77% of Flipkart for this amount, valuing India's most valuable consumer internet startup at about $21 billion. The investors made a lot of money in this. And the buyout, which is, remember, Walmart's biggest acquisition and the biggest e-commerce deal globally, really marked the end of an era for Flipkart, as even the co-founders Sachin and Binani Bansal left, of course, for different reasons. Now, Flipkart's existing management team will be led by the CEO, Kalyan Krishnamurthy, who will continue to lead the business. And also remember that the existing investors, Tencent Holdings and Tiger Global Management, will really remain and will be represented on the board. And remember, on this particular transaction, CCI approved the Flipkart-Walmart deal despite protests coming in from the traders across the country over fears that the deal would really drive several small retailers out of business. Remember, convergence of e-tail and retail is fructified in the year 2018 with this transaction.
The two businesses, if you just look at Walmart, if you look at Flipkart, have very unique strengths and capabilities, both market leaders in its own way. And the contribution to the customers from both of these platforms have been huge in the last several years. What we try to do is to learn from each other and apply it to our own businesses. If you look at sourcing, if you look at supply chain operations, there are several things for Flipkart to learn from Walmart, and we actually look forward to learning those and implementing those at Flipkart.
What really marked the deal street in 2018 is clearly also the appetite by the Indian conglomerates, the big business houses, to really go overseas once again and make big bang acquisitions. And that particular leap of faith really came in from Kumar Mangalam Birla's Hindalco, which announced the acquisition of another global aluminium player, Aleris, for $2.5 billion, which will be paid by a mix of debt as well as cash. Now, remember that Aleris acquisition will give a recurring $150 million of synergistic benefits from the third year, is what the company had to say. The biggest advantage that is really coming in for Hindalco is first the footprint in the lucrative markets, and also getting into and also improving the product mix, which is more towards the auto segment, which is more lucrative in their business.
Novelis is a very valuable company today. It's to our mind valued at between $10 to $12 billion. It's also a global leader. It has consolidated its leadership position globally in the last 10 years. Very profitable, and it's a prized asset in any which way that you look at it. I think Aleris is a step forward in the Novelis story of increasing Hindalco's share of value-added products in its product mix. Aleris takes that ambition forward. It gives Novelis a foray into some new segments. Yes. For example, building and construction. For example, very interestingly, aerospace. So in aerospace, it gives Novelis access to customers like Boeing, like Airbus, like Bombardier. So you have very sort of revered marquee customers that also come in terms of franchises along with Aleris. So absolutely, I think the success of Novelis has been very encouraging, and that is what has spurred us to now take the next big step forward with Aleris.
What is the kind of synergistic benefit that Novelis, Hindalco are going to get on a consolidated basis with this acquisition, and when will it start kicking in on the balance sheet?
So firstly, I must emphasize that this transaction is being done on the balance sheet of Novelis and not Hindalco. Of the transaction value, $775 million is the equity part of it. Yes. The rest of it is debt that Aleris today has and that Novelis will take on from Aleris. Synergies are on several fronts. On the fronts of supply chain, on the front of SG&A,
Yes.
Also, we have complementary assets in China, as in both Novelis and Aleris have assets in China that are close to one another and that kind of fit into each other.
This one is also coming in from Aditya Birla Group, and Kumar Mangalam Birla's team at Ultratech really fought a fierce battle against another competitor in the cement business, Dalmia Bharat, to acquire Binani Cement, which was under the Insolvency and Bankruptcy Code. It was a hotly contested battle in the courts of law, where it really went to NCLT, NCLAT, and even the Supreme Court. What Ultratech had done, even after Dalmia Bharat had really won the bid and the COC had approved them as the winner, Ultratech went ahead and not just charged that it was a flawed decision which was being taken by the COC, but also gave additional 1,000 crore rupees for the buyout. So almost upping the game to 8,000 crore rupees for buying out Binani Cement. And finally, the Supreme Court ruled that Ultratech's offer is really paying 100% of the secured, unsecured lenders and all the operational creditors. So clearly, maximization of value through the IBC processes, through the NCLT route for the debt-laden companies came out loud and clear in this transaction and definitely changed the rules of the game for the IBC forever and set a precedent for many deals in the pipeline. So it was not just Birlas, but even Tatas. They were really active on the deal street and went all out when it also came to the NCLT process to take advantage of the distressed assets on sale under the IBC route. So recovering from the defeat, remember, that they got from Vedanta in buying out Electro Steel. Well, Tata Steel had gone all out to acquire Bhushan Steel and also offered a much higher price than their closest competitor. Remember that the acquisition of Bhushan Steel is extremely important, and that was also fueled by the joint venture formation that Tata Steel also announced in the year with ThyssenKrupp for its European operations. Remember, it's a landmark deal for managing the debt concerns of Tata Steel and also to fight the tough competition and the tough business environment in the European markets. So had ThyssenKrupp really not been sorted, Bhushan Steel could have been much more difficult as far as the huge debt is concerned. Now, deal with ThyssenKrupp was signed in June, and the planned entity still needs the European antitrust approval, which is expected towards the end of the first quarter of 2019. But remember, there has been delay and uncertainty also due to the Brexit debate, which has really impacted this transaction.
You know, this is a collaboration and a partnership that has been built on very strong industrial logic and footprint, and I think the Indian shareholders and the company will be in a much more financially robust position. Not only are we going to look at deleveraging on the deconsolidation of about 2.5 billion euros of debt, we will have consolidated interest costs which will come down by about maybe 1,000 crores. We create balance sheet appetite for the growth in the Indian business, and therefore I think it will certainly have an earnings accretive position. Not to mention about the fact that as a 50-50 joint venture, when we account it on an equity basis, we will have the earnings of the joint venture company, and with our expectation is also that it will be a free cash flow business from which the shareholders will be duly serviced.
You said that 2.5 billion euros passed on to the joint venture that will be deconsolidated from Indian entity. So that means 20,000 odd crore rupees going from your overall net debt that you left in the end of FY18 at 86,000 crore rupees. So that will reduce to 66,000 odd crore rupees. But then you're also buying out Bhushan Steel, where you've said that you're taking a debt of 16,500 crore rupees. What are your plans for debt management? Are you comfortable with these levels? And with this debt on your books, would you still pursue Bhushan Power and Steel?
So I think if you have to look at the Bhushan Steel acquisition This has been done on a very prudent capital structure. We've contributed about 18,000 crores of equity related from Tata Steel and about 16,500 of debt for a 5 million plus ton facility with very strong asset configuration, especially on the downstream.
Now let's coming to a sector which had a huge amount of potential for large transactions in the year 2018. In fact, I would say that many efforts were being made, but many did not fructify. There are few successes and many failures when it comes to the deal street in financial services space. But the largest one of all was the creation of IDFC First Bank by merging IDFC Bank and Capital First. It is one of the largest transactions in this particular sector, which had been plagued by many other concerns. Now, while a lot of really deals took off in the sector, including especially from the insurance sector, many of them really did not fructify, and later on the market volatility also stalled a huge amount of them. But this particular merger of IDFC Bank and Capital First, announced in January and got consummated by December, will be under the leadership of V. Vaidyanathan, who created Capital First, and the marquee private equity firm, remember Warburg Pincus, which backed Capital First, also becomes the big investor in the new bank created.
Mr. Vaidyanathan, a lot is riding on you. In fact, the market is really looking up to you for the retail growth of IDFC Bank. Now, you have really originated a kind of business which will give a lot of cross-selling opportunities and the retail portfolio and assets to the bank. But as far as getting deposits are concerned, Kotak Mahindra Bank, Yes Bank, at higher rates are also struggling at this point. What is your strategy there, and what is the timeline and the target you're looking at? Because markets are very keenly watching out for these targets.
I think it's an absolutely good question, and I think probably one of the very most important questions. In my opinion, when you look all around us at the grassroots level, you see shopkeepers, you see people, you see employees, etc. You just see there is so much opportunity. Everybody needs to keep the savings somewhere. Number two, if you see the Indian economy's growth over the next 10 years, I just read a report, that Morgan Stanley report talks about 6 trillion economy in 2000, and we are 2.3 trillion today. Now, where is the extra 5 trillion going to be financed from? And where are the savings going to come from? They're going to park it somewhere.
Opportunity to put these two complementary businesses together and create something that is multiples of where it is today. So, I mean, if you ask me as an investor, I'm thrilled with Capital First as it was. Vaidyanathan's done a great job. This is not, I just want to point out, it's not an exit for us. To Chip's point, it's a reinvestment. So for us to stay in this and own 10%, we have to be prepared to say, we're in here and we think the next many year story is exciting for us to make multiples from where it is today.
While we talked about Tatas and Birlas, Ambanis can't be left behind. In fact, I would say that this year they have been more of a propeller of consolidation in many sectors than themselves doing a lot. But in a swift move, Mukesh Ambani's Reliance Industries has acquired majority interest in India's two largest cable, TV and broadband companies, Hathway Cable as well as Den Networks. These are large transactions, majority stake in both the companies. And it's important because remember, 2 years back when we were talking about, and we even broke the story of Idea as well as Vodafone merging, coming together because of the stiff competition coming in the telecom sector, the next in line had to be the related segments like cable TV as well as DTH. And that's exactly what happened in this particular transaction, which is worth about 5,200 crore rupees. So mega transaction when it comes to the consolidation in the cable TV business, also putting pressure on the other existing players who are finding it difficult to manage the competition and also changing realms of technology in this segment. Another big acquisition, and this was from the space of the hospital segment. In fact, hospital segment has been really a buzz with a lot of action. A lot more consolidation is really to happen, and two deals got struck here. First, the big one of Fortis Healthcare, which almost lasted for a couple of years with many twists and turns and many of the minority shareholders having a say, even changing the board, and many contenders and many suitors really coming in this particular transaction. So it was again a very fiercely held battle for Fortis Healthcare, which was finally won by the big global player IHH. And the combination of both preferential allotment and open offer has been proposed in this transaction. The preferential allotment worth about 4,000 crore rupees. That amount of FDI is already in, and IHH is already in control of Fortis Healthcare. But remember, there is a little bit of hurdle in this. The old Daiichi Singh brothers case has come to haunt this transaction again, even though many remedial measures were being taken by the company to disentangle both these entities, Singh brothers as the erstwhile promoters, as well as Fortis Healthcare as a separately listed company. So right now, where we stand is that the court has asked IHH to not go ahead with any more of the transaction, which means the open offer, which is still pending, remains pending at this point.
I think then there were a couple of turn of events that happened. I think there was a lot of news coverage, and when the sort of dust settled beginning of this year, I think it was at the end of February or March, at that particular point in time, we realized that the Fortis process started again. We got onto the same platform to look at Fortis. So we've always been on the lookout for opportunities in India.
Right. And what about the second part of my question, the valuation dynamics? What drove the valuations to 170 rupees per share, and how much did it come down by because of the findings of the investigation report by Luthra and Luthra?
I think there were multiple data points. There was not one particular sort of set in terms of the data points. In terms of the multiple data points that we have, we actually triangulated. I think in terms of the performance from about a year ago, plus the due diligence findings, to the final audited financial statements in terms of the qualifications, I think the investigation that went into as a result of what was audited by the board.
Deal Street in 2018 also saw a fair bit of aggression coming in from the smaller players. Take, for example, this large transaction that got announced right at the fag end of the year 2018 in the hospital space. Now, Radiant Life, we know, was extremely keen to buy out IHH, was in the fray. But after losing out on that one, the next big pick for Radiant Life has been to buy out Max Healthcare. Now, Radiant Life, backed by KKR, the private equity firm, has now announced the transaction to buy out Max Healthcare and to create the third largest hospital chain in the country. As part of the transaction, KKR will own 51.9% stake. Abhay Soi, the promoter of Radiant Life, will be owning 23.2% stake in Max Healthcare. And on conclusion of this transaction, Max Healthcare will really comprise of Max Healthcare's business of Max India as well as Radiant Life's healthcare business, and that will be demerged into Max Healthcare scheme and will also result in a creation of a listed entity. So that's a large transaction and a big one at that, coming in the hospital space yet again. So consolidation in the hospital space is here to stay.
This basically results in a pure play healthcare listed entity, as Max India will demerge its non-healthcare business, and Radiant, that we are already a partner with Abhay Soi, will basically buy out Life Healthcare in Max Healthcare. It's a very fragmented sector. We need to consolidate. We need to bring in a lot of efficiencies, which I think Radiant and Max Healthcare will bring in through synergies and smarter procurement, better clinical service. And I think, sky's the limit. There's probably more consolidation in the sector ahead here.
All right, so those were the top 10 deals for the year 2018, which made it to my list. But remember that I was spoilt for choice. There were so many more multi-billion-dollar deals that have really fructified in the year 2018. Many are still waiting for approvals and many in the pipeline for the next year as well, where the deal talks have begun. But for 2019, I would say that market volatility as well as uncertainty ahead of the elections can be a big dampener for the deal street. But besides that, market volatility is also something that has really given a big body blow to the ECM transactions, the equity-related deals as well. So we'll have to see, because without even expecting, a lot of transactions got culminated in the year 2018, and we just hope that same will be the case in the new year as well. So happy deal making and have a great 2019 to all our viewers, and keep it with CNBC TV 18 in the new year as well.